Successful, and one of the reasons we had such a great year last year trading for clients in the S&P was simply using credit spreads. I mean, not credit spreads, but covered call spreads in the S&P, where we would actually buy the S&P and then sell a call probably about 2 strikes or 10 points above it. And I always got questioned about why I would want to limit my ability to make money on something like that. And, they're short-term options. Again, they're 30 days. So if we're at 1352 right now and I'm long and I'm relatively bullish, I would sell the 1360 call against it. If this were, mid-August, or I would be doing the one for October. It does a couple of things. Now, I know it locks in the amount I can make. I still use the futures. I still use a stop. I mean, I'm not going to let the futures go down to 1,200 and be happy because I sold the 1360 call. I'll use a stop there, but markets aren't going to go to the sky, and you can't play for a crash every month. Crashes don't happen every month. So if you're short the market, go ahead and sell the put against it, collect some premium. You'll get a good premium, too, for it, especially on the put side. It was in August of last year that doing so, we collected a 45% return for the month. Everybody wants to play for a crash. Do I think it's going to go to 950 sometime this quarter? Yes. But I am still selling covered puts in some of my portfolio. You just can't ignore the money that they're giving you. If they're going to give it to you, take it. And never be upset just because, gee, I only made $8,000 in this S&P trade. Well, gee, I mean, let's don't, we tend to get greedy. We always want to call tops and we always want to call bottoms. At least have part of it covered. And you can do the same thing if you're long a put or long a call. If you're long in July, the Y2K newsletter, we had people buy the September 1370 puts when we were trading at 1425, something like that. We got a decent break, and for those who didn't want to take their quick profits, recommended selling the September 1330 puts. So for those people that just wouldn't get out and wanted to hold on, they were able to sell those. And actually, I think by the time it broke down, they were able to get almost as much for the 1330 put as they paid for the 1370 put. So in a sense, and I hate this term, it became a free trade. The only problem is when you do that, then you're kind of setting that trade until expiration. And you're at that mercy, and that money's kind of tied up. But if you really want to stay in there and try to make the full, in that case, the 40 points that they had, that's fine. That's just another strategy you can use when you're long an option and not initially doing that debit spread. Because when you initially do the debit spread, you kind of locked in. If you are, I talked against it, but if you do debit spreads in the S&P, they should be at least 30 points away from each other. So if you're going to do the 1350 and you're buying that, then sell the 1320. It gives you the ability, when the market breaks, to do a couple things. Either roll the 1350, sell that one, and buy the 1340 and lock in some profit, or reverse it and roll up. If you go 10 points, you've really locked yourself in. You can't do too much. So it should be at least 20, but I prefer 30 points on that. And that's how it works out the best. But covered call writing works in every field. Well, I don't know about lumber because I don't trade lumber, but you can do it in soybeans. You can do it in the bonds. It's really a good strategy, but people don't like it, again, because they think it's boring and it ties funds up. One of the things I did as a stockbroker was to have folks do covered call writing in stocks. And they were always happy when the option expired worthless, and always mad when it got called away. Well, you just made all this money. Yeah, but it's going up higher, which is also another slight point. Once you're out of a trade, forget about it. Don't go back and keep looking at the paper or your screen, thinking that you stay in it longer. It's always a mistake. Use covered call writing in soybeans. I'd say 25 cents. In wheat and corn, wheat's 20 cents. Corn is about 10 cents. As a rule of thumb, that's probably where you're going to get your most returns. Stick with things that are boring. Don't try to do all these wild strategies. Don't go out and try to do a long butterfly, or you're just going to get chewed up in commissions. Take a couple steps back, from trying to do sophisticated trading that doesn't make any money to doing the simple things that actually will make money. And truly, besides doing the credit spreads in the S&P, doing covered spread or covered positions in the S&P has been probably my two best money makers that I've done. Do you have a question about